when the market doesn't appreciate a stock, one of the best ways for management to add value is just to simply buy back shares outstanding. And I think that's one of the things that General Motors has gotten right over the past few years. This is a company that is buying back about 20% of their shares outstanding on an annualized basis, and they continue to buy back shares because shares are trading for just 5 times earnings. So I'm going to go through exactly what's going on with GM, how their operations look, because not everybody in the auto industry is doing well right now, but GM is. And I think there's a lot of bright spots. And in the meantime, the company is going to buy back a significant amount of their stock in 2025. I think that will help push shares higher long term. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's look at some of the operating trends for GM because I think this is fundamentally what's most important to keep an eye on. And the two metrics that I'm showing here are total revenue. You can see that that continues to climb. Not a super high growth company. Yes, they grew coming out of the pandemic when they were able to make more cars because they weren't part of the chip shortage any longer, but still growing in the most recent quarter. I'll get to some of those details in just a second. But the other thing is GM has been solidly free cash flow positive. That's really the fundamental thing that we need to think about if you're looking at GM as a buyback stock. Over the past year, $13.2 billion in free cash flow. That will ebb and flow a little bit over time. They just announced that they were going to be investing another $4 billion in the US. You have some downtimes when you had the strikes, but overall, this is a company that continues to generate a significant amount of cash, and they have a much better balance sheet than you might think. If you look at a lot of sites who look at their balance sheet, it looks like they have $100 billion worth of cash. That's not really the case because they also have a financing arm. Their auto business actually has a net cash balance. So things are looking really good from an operating perspective and from a balance sheet perspective. But one of the things I want to highlight here is the pace of buybacks of stock and also the price that GM is paying for that stock. So this just shows the amount of shares repurchased, and these are trailing 12-month numbers. So they had an accelerated repurchase program that they announced late in 2023. That's why that jumps to about $10 billion. But even over the past year, you're looking at about $8.8 billion. The shares outstanding goes from 1.5 billion shares outstanding to right now, we're actually under a billion shares outstanding. If you just look at, this is a weighted average number. So this is a weighted average number over the past year. But as I'm speaking right now, there is less than a billion shares outstanding for GM. And look at the price that they're paying. The orange line is the price to earnings multiple. So you can see that that's about 7 right now. But look, when they were buying back shares, you're looking at 5, 6 times earnings. That is a phenomenal price to be buying back shares, especially if operations continue to grow. And that's what I think is so impressive about GM right now. The business is actually doing really well. So let's go through some of the operating trends. And this is based on their most recent earnings report that came out at the beginning of May. You can see that market share in the US was up 1.8 points year over year to 17.2%. They are now number 2 in EVs that have over 10% market share there. That continues to grow at a really incredible rate. And they continue to have strong free cash flow, $0.8 billion in adjusted auto free cash flow just for the quarter. And what's the reason for that? People are still buying large trucks and SUVs. And this is really the biggest number that you need to keep in mind in the auto business, I think, overall. These large trucks and SUVs are the most profitable segment of the auto business, and GM just absolutely dominates it with 69% share in full-size SUVs, and they're gaining market share in kind of the other ancillary businesses. So the Traverse is going to be another larger vehicle, but not quite as big and expensive as a Suburban or a Tahoe, GMC Acadia, Enclave. These are all growing at a really rapid rate. In the EV business, so this could be the potential threat to General Motors, is that a company like Tesla takes share in EVs, but that's not really the case. Tesla's actually losing market share in EVs, and GM is picking up share, up 94% from a year ago, now 10.4% market share. This is one of the interesting things. I think, I see GM EVs popping up all over the place, whether it's the Blazer or the Lyriq, the Cadillac Lyriq. I think that ultimately looks really compelling. And it's becoming more popular, at least where I'm at. Vehicles are going to be very regional. I live in an area that is very General Motors heavy, but the fact that those GM buyers are shifting to electric vehicles is really notable for the company. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. They also have some optionality in the future. So this is Super Cruise. They also acquired Cruise, their former subsidiary that did autonomous driving. they're not going to put that level 3, level 4 autonomous driving technology into vehicles that people can actually purchase. That will be through the Super Cruise brand. And I think this is just the kind of thing that could potentially drive GM going forward. It isn't necessarily going to be an earnings driver over the next year or two, but 10 years from now, does this kind of keep the company from getting disrupted? I think that could be the case. Now, tariffs are going to be a headwind. This was the big thing in the last conference call, was a discussion about tariffs. The tariff announcement happened in April. These earnings came out in May. They actually delayed their earnings results so that they could kind of get some idea of exactly what these tariffs are going to look like. So previously, they did expect to be a little bit more profitable. Previous guidance was for $11 to $12 worth of earnings per share. Now that's down to $8.25 to $10. But you're seeing the company continue to be proactive and make moves to keep that profitability long term. And the real key in this business is demand. Who has a demand for vehicles? GM is the company that I think has probably the most stable brand right now, as we've seen declines in a lot of Stellantis' brands, in Tesla. Even Toyota and Honda haven't been performing nearly as well as they did previously. GM's the one that's holding up really well and taking market share. So if they're taking market share and the stock is trading for 5-6 times earnings and management is buying back 20% of shares outstanding on an annualized basis, that's how you get phenomenal gains for long-term investors. And just to answer that balance sheet question that I brought up earlier, this is how they break out the business. So the automotive business is going to be right here. Cruise, they fully acquired, so let's ignore that. And then there's GM Financials. This is essentially a bank that's providing loans for people to buy GM vehicles. But the auto business has $12 billion in cash, $6.9 billion in marketable securities. And if we go down here, debt for the auto business, $13.4 billion, and $2.4 billion of that is short term. So $15.6 billion. They have more than that in cash. So like I said, a net cash balance for the auto business. Yes, GM Financial does not have a net cash balance. They do have $8.4 billion worth of cash. And their short-term liabilities, almost $34 billion and $83 billion in long-term liabilities. That's because that's what they do. They loan money to companies to people who are buying vehicles. That's why they're going to have a lot of debt on their balance sheet. This would be like being worried that a big bank has a lot of debt on their balance sheet. That's how the business works. So you add all these things together, I think this continues to be one of the best value stocks on the market today. If they continue to buy back stock as aggressively as they have, or even if they pull back a little bit just to get through whatever the next turbulence for the next 6 to 12, maybe 18 months with the Trump administration, with a potential recession coming, that could be potentially a good move. Save a little dry powder to be able to get through that and then continue to buy back shares, because it doesn't look like that multiple is going up anytime soon. But I think long term, they're going to buy back stock so aggressively that is going to funnel its way to an increasing stock price for investors. But let me know what you think about GM stock and their buybacks. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.